In March 1980, the price of silver collapsed 50% in a single day. Fortunes evaporated. Investors who thought they owned physical silver discovered they owned nothing but paper promises. And two of the wealthiest men in America faced accusations of attempting to corner the entire global silver market. But here's what they do and tell you in the history books. The fraud didn't end in 1980. It evolved, it became more sophisticated, and if you own silver today or think you do, you need to understand what really happened, because the same mechanisms that enabled the Hunt brothers scheme are still operating right now, just under different names. What I'm about to show you isn't conspiracy theory. It's documented evidence from court cases, congressional hearings, and whistleblower testimonies that reveal a systematic pattern of manipulation spanning decades. By the end of this video, you'll understand why silver prices behave differently than almost any other commodity, why certain banks keep getting caught in the same schemes, and why the ratio between paper silver and physical silver should terrify anyone who thinks they are protected by precious metals. The question isn't whether silver markets have been manipulated. The question is, how deep does it go, and what does it mean for your wealth right now? Let's start at the beginning. To understand the fraud, you first need to understand what makes silver different from almost every other investment on Earth. Unlike stocks or bonds, silver is a physical commodity with dual nature. It is both a monetary metal, a store of value people have trusted for thousands of years, and an industrial metal critical to electronics, solar panels, medical equipment, and technology. This creates a unique tension. Industrial users need stable, predictable prices, while investors want silver to rise as a hedge against inflation and currency debasement. Now, here's where it gets interesting. Unlike gold, which mostly sits in vaults, silver gets consumed. It's used in such small quantities in each product that it's often not economical to recycle. This means silver is disappearing from above-ground stockpiles while demand continues to grow. Simple supply and demand economics would suggest silver prices should be rising steadily, but they don't behave that way. And that's your first clue that something is broken in this market. Enter the futures market. In the 1970s, as the dollar was cut from its gold backing, commodities futures trading exploded. The idea was simple: allow producers and consumers to lock in future prices, reducing risk for everyone. A silver miner could sell futures contracts guaranteeing a price 6 months from now. An electronics manufacturer could buy contracts locking in their silver costs. Beautiful in theory, but there was a loophole, a massive loophole. You didn't need to own actual silver to sell silver futures contracts. You could sell paper promises of silver that didn't exist, creating what's called a naked short position, and if enough people did this simultaneously, they could suppress the price of silver regardless of actual supply and demand. The Hunt brothers understood this loophole, but they approached it from the opposite direction. Nelson Bunker Hunt and William Herbert Hunt weren't your typical investors. They were Texas oil billionaires, sons of the legendary H.L. Hunt, and in the 1970s they became convinced of one thing: the dollar was doomed. It wasn't an unreasonable belief. President Nixon had just severed the dollar's link to gold. Inflation was soaring into double digits. The purchasing power of cash was evaporating monthly. The Hunt brothers decided to protect their wealth by converting dollars into something real, something that couldn't be printed: silver. They started buying in 1973, not just silver futures contracts, but physical silver bars, coins, everything they could acquire. They took delivery, which meant they demanded the actual metal rather than settling for cash. This is critical to understand. Most futures traders never take delivery. They're just betting on price movements. But the Hunts were accumulating the physical metal itself, creating a genuine shortage. By 1979, the Hunt brothers, along with their allies in Saudi Arabia, controlled an estimated 100 million ounces of physical silver, roughly half the world's deliverable supply. Think about that. Two individuals and their associates controlled half of all the silver available for delivery on Earth. The price responded exactly as you'd expect from basic economics. Silver went from $6 per ounce in January 1979 to over $49 in January 1980. That is more than a 700% increase in 12 months. The Hunt brothers' positions were worth billions. Anyone who owned physical silver had watched their wealth multiply. It was the greatest precious metals rally in modern history. But here's what most people miss. The Hunt brothers didn't break any laws by accumulating silver. What happened next wasn't about prosecuting illegal activity, it was about protecting the system. On January 7, 1980, the board of directors at the COMEX, the major commodities exchange where silver trades, held an emergency meeting. What they decided would change everything, and it should make you question who commodities markets really serve. They implemented Silver Rule 7. This rule changed the game entirely. It limited traders to liquidation-only positions. That means if you own silver futures contracts, you could only sell, not buy more. But here's the crucial detail: this rule only applied to long positions, to people betting that silver would rise. It didn't restrict short sellers, those betting silver would fall. Read that again. The exchange changed the rules mid-game to favor one side of the market. The Hunt brothers couldn't buy more contracts to defend their position. Short sellers could pile on, knowing the rules protected them. The fix was in, but there's more. Margin requirements, the amount of cash you needed to hold positions, were raised repeatedly, specifically targeting long holders. Within weeks, the Hunts needed to post hundreds of millions in additional collateral just to maintain positions they'd held for years. Then came Silver Thursday, March 27, 1980. Unable to meet margin calls totaling $100 million, the Hunt brothers' positions began to unwind. The price of silver collapsed from $21 to $10.80 in a single day. The brothers lost billions. Banks that had lent to them teetered on the edge of failure. The financial system itself was at risk. The Federal Reserve and a consortium of banks arranged a bailout of sorts, a $1.1 billion line of credit that prevented complete collapse but stripped the Hunts of their silver empire. They later faced civil charges for attempting to manipulate the market. But here is the question nobody asked publicly: if naked short selling silver that doesn't exist had been suppressing prices before the Hunt brothers accumulated, weren't they simply correcting an existing manipulation by demanding physical delivery? And if COMEX changed the rules to crush long holders, who was really manipulating whom? The official story says the Hunt brothers were villains who tried to corner the market. But the evidence suggests something more complex. They exposed how easily paper silver could be created, and the system responded by protecting the paper, not the physical reality. You'd think after such a spectacular failure, regulators would implement reforms to prevent future manipulation. You'd be wrong. The years following Silver Thursday saw increasing evidence that the problem hadn't been fixed, it had been perfected. The very mechanism that enabled excessive short selling continued, only now with the implicit understanding that exchanges would protect paper markets over physical reality. In 2004, a metals trader named Andrew Maguire began noticing suspicious patterns in silver trading. Large banks would systematically sell massive quantities of silver futures contracts at specific times, particularly when technical buy signals appeared that might send prices higher. These weren't normal market operations, these were coordinated interventions. Maguire did something brave. He contacted the Commodity Futures Trading Commission (CFTC) and told them exactly what would happen before it happened. He predicted the precise timing and magnitude of price manipulations, and they happened exactly as he described. He had the evidence, he gave it to regulators, nothing changed. Then in 2008, a silver investor named Bart Chilton, a CFTC commissioner, publicly stated that the CFTC had uncovered evidence of repeated instances of fraudulent efforts to persuade and deviously control silver prices. The investigation dragged on for 5 years. In 2013, the CFTC quietly closed it without filing charges, stating they couldn't prove violations beyond a reasonable doubt. But here's what did happen during those same years. JPMorgan Chase admitted to manipulating precious metals markets in 2020, paying $920 million in fines for spoofing placing fake orders to move prices. Deutsche Bank, UBS, and other major banks settled silver manipulation lawsuits for hundreds of millions of dollars, though without admitting wrongdoing. The pattern repeats, evidence emerges, settlements happen, but the fundamental structure enabling manipulation remains untouched. Now we arrive at the present day, where the fraud has evolved into something even more concerning. Today's silver market operates on what experts call fractional reserves, silver, the same principle that allows banks to lend more money than they actually have in deposits. It's estimated that for every ounce of physical silver, there are somewhere between 100 and 500 ounces of paper claims on that silver through futures contracts, options, ETFs, and derivatives. Let me make this concrete with shocking numbers. The annual silver production worldwide is approximately 830 million ounces. Total silver trading volume on COMEX alone exceeds 1 billion ounces every few days. The entire year's global production trades in less than a week. How is that possible unless most of what's trading is paper, not metal? Here's where it gets even more disturbing. In 2021, Reddit investors in the Wall Street Bets community attempted a silver squeeze, buying physical silver and shares of the SLV Silver ETF to force short sellers to cover positions. The price jumped briefly, but what happened next was revealing. Buyers discovered multi-week delays in obtaining physical silver. Premiums the price above spot for actual coins, and bars soared to 30 to 50%, while paper silver prices barely moved. This divergence tells you everything. The paper market and physical market were disconnecting. You could buy contracts for silver at $25 per ounce while paying $35 for actual metal. The fraud was becoming visible in real time. And here's the modern twist that should terrify you. Silver ETFs like SLV claim to hold physical metal backing your shares, but read the fine print. The prospectus explicitly states they may hold unallocated silver, metal that isn't segregated and could be claimed by multiple parties. They admit they might not have all the metal they claim. It's right there in the legal documents, but almost nobody reads them. Meanwhile, the same pattern identified by Andrew McGuire continues. Data analysis from independent researchers shows that large concentrated short positions in silver are held by just a handful of banks. These positions would be illegal in most other markets due to position limits, but exemptions exist for bona fide hedging, a loophole you could drive a truck through. The evidence suggests we're living through a slow-motion version of the Hunt brothers scenario, except reversed. Instead of attempting to corner physical silver, certain entities appear to be cornering the paper market to suppress prices, ensuring the dollar remains more attractive than alternatives. Why would they do this? Because surging silver prices would signal inflation concerns, currency debasement, and economic instability. It would validate the very fears the system needs people to ignore. So what does all this mean for you? 3 critical takeaways. First, understand the difference between paper and physical. If you own silver futures, options, or even some ETFs, you likely own a claim on silver, not actual silver. And as we've seen repeatedly, when everyone tries to exchange claims for physical metal simultaneously, there isn't enough to go around. The paper promises exceed physical reality by orders of magnitude. Second, price suppression mechanisms are real and documented. This isn't speculation. Banks have admitted to manipulation and paid billions in fines. The question isn't whether it happened, it's whether it ever stopped. The evidence suggests the same structural problems that enabled past manipulation remain embedded in current market architecture. Third, the silver market may be the canary in the coal mine for larger financial system fragility. If the ratio between paper claims and physical assets is this distorted in silver, what about other markets? How much of what we call wealth is merely accounting entries that couldn't be converted to real assets if tested? Here's your warning: every fraud eventually collapses under its own weight. The Hunt brothers scheme ended in silver Thursday. The housing bubble ended in 2008. The gap between paper silver and physical silver is widening, and history suggests that gaps like this don't persist forever, they snap violently in one direction. The question you need to ask yourself is, when the next crisis hits and people rush toward tangible assets, will your claims on silver be honored? Or will you discover, like investors in 1980, that you own nothing but promises that can't be kept? The evidence is there, the pattern is clear. The fraud isn't some ancient history confined to Texas oil barons. It's operating right now, more sophisticated and more pervasive than ever before. What you do with this information is up to you. If this investigation opened your eyes to what's really happening in precious metals markets, hit that subscribe button. We're diving deeper into financial frauds the mainstream won't cover. And drop a comment below. Do you own physical silver, paper silver, or neither? Let's discuss what you're seeing in the markets. The truth won't protect itself, neither will your wealth.